Hey, how you doing? And welcome to Livewire's Fund in Focus. I'm Ali Selby, and today we're very lucky to be joined by Luke Laretive from Seneca Financial Solutions to learn more about his small cap fund and also why he believes there's so much opportunity in small caps over the year ahead. Thanks so much for joining us today, Luke.
My pleasure.
Let's start at the very beginning. Why did you launch the fund in the first place?
I think we've been stockbroking small cap equities for a long time. That's kind of our background, is around a stockbroking business. And it just got unsustainable to continue to grow like that. You know, you can only call so many people in a day. You can only get so many people into a relatively liquid stock at a given time. And certainly it just became more evident to us that running a fund, being able to give everyone the same price at the same time, be able to buy and sell really efficiently, became the best way for us to get our clients exposure to small caps.
Okay, you've had a cracker of a year. The fund's returned at 28.36%. Congratulations. So that's an excess return of nearly 10%. What did you get right over the last year?
Yeah, look, we're really pleased, and it's been a really great way to start, I suppose. You know, you don't get a 20 or 30% year at the start of your fund all the time. So, you know, very fortuitous time to start. That being said, we do think, you know, smalls were poised to outperform. What we got right, I suppose we kind of invest in four main categories during the year. Some scarce commodity plays made us a lot of money. We also did well out of some sort of asset plays. You know, we've got a situation where a company might have great assets, but the market's not pricing them. And then kind of our core business, which is either sort of inflecting profitability, small caps that are kind of becoming profitable, or those businesses where growth that's happening just isn't really priced appropriately by the market, sort of undervalued or underappreciated.
On the other side of that, we all make mistakes. I've definitely made a few over the last year. What did you get wrong?
Yeah, sure. We definitely got some things wrong during the year. We had about a 62% win rate, so probably 48% of our calls, you know, didn't go our way. But importantly, you know, we made an average return of 42% on those positions that we did make money on, and we only lost 19 on the ones that we didn't do so well on. So overall, like a really positive year. I think investing in smalls, you know, you get paid to make calls and you're out there to invest in stuff. And I don't really mind catching the odd earnings downgrade or the unexpected sort of, you know, falling short of expectations. That's going to happen. And I suppose companies maybe like Webjet, DGL, they had sort of difficult trading updates that maybe weren't what we were expecting at the time, and certainly detracted from returns. But sort of on the whole, we were able to manage those reasonably well, and certainly had other stocks that sort of more than made up for it.
Have you learnt any major lessons from those mistakes that you think will shape how you invest going forward?
I think just continuing to have like the courage to make the calls. I think you can go into your shell a little bit if you get one or two earnings calls wrong, in a particular period of time. So I think, you know, it's great at Seneca. We've got a business that's, you know, owned by the management team, owned by staff, and really encourages people to make calls, to put their neck on the line and say, hey, well, I think this business is going to outperform for X, Y, Z reason. So no, like I don't think we've learnt something specific, but I think we've learnt that, you know, making calls sometimes goes wrong, and we should be embracing that and not getting too hung up on the fact that, you know, you can't perfectly forecast the future.
There's obviously quite a few small cap funds available to Australian investors. What do you think is your secret sauce? Like, what makes you different to the rest of the pack?
I think, you know, we're a independently owned business, heavily invested in our own products, with, you know, the majority of my net worth being in the funds and in the business itself. I think that entrepreneurial sort of lens gives us a unique angle when we're looking at companies, maybe relative to someone who's a salaried sort of institutionalised fund manager out there.
You got more on the line, I guess.
More on the line, but also, you know, when you're running a business, it's rather than just sort of studying people running businesses, you're actually running a business at the same time as investing in other people's businesses. So that sort of, entrepreneurial approach, I think, does sort of tilt how we invest and the kind of companies we like to buy and the kind of characteristics we like to see in management teams and those kind of things. It's from that sort of like practitioner type level. So I think that's a little bit unique to what we're doing at Seneca. And certainly I think it's definitely contributed to the success of the fund so far.
Does it impact how you think about risk then?
Yeah, definitely. I think, you know, we think about risk in it's the price that you pay for things. It's not so much that we're savants and we can call the markets, or I think when you look at the statistics in drawdowns, most small cap managers have about 30% drawdown. That's just doesn't matter whether you're top quartile, bottom quartile. Everybody gets hurt when the market falls. I think the question more is when the market does rise, can you buy stuff at cheap prices? Can you make more money when the sun is shining and the markets are going up, because they do go up more often than they don't? And certainly, I think from an individual stock perspective, it's giving yourself a margin of safety to your valuation. Can you buy things at prices where even if things don't go to plan, even if earnings don't end up where you think they might, do you have a fallback position?
Are you still seeing a margin of safety now in small caps, considering we have seen the Small Ords run quite hard over the last 12 months?
Yeah, I think there is. I think at the more liquid end of the smalls, it can be more challenging. I think pretty much at the moment the rule is the higher up the market cap you go, the more overvalued it gets. I think there is a sweet spot there, probably in the mid cap, small cap sector, where there is still a lot of value on offer. So yeah, no, I do think there's a margin of safety there. Not with every stock, that's for certain. And I think the things that have done really well over the last 12 or 24 months, a lot of the future is now baked into those prices.
You talked about liquidity just then. What else is important to you when picking stocks? Are you okay with backing like profitless companies, particularly in that small cap, micro cap arena? Like, what are the factors that are important to you when a stock makes its way into your portfolio?
I think there's probably different strokes for different folks a little bit. And it depends on the kind of stock we're buying. We will buy something that's unprofitable. We will buy something that's emerging. We will take some exploration risk if we need to. I think it's the size of those positions that matters more. Certainly being a smaller fund, we do have opportunities to invest in things that are a little bit less liquid than maybe a $500 or $1 billion small cap manager out there. So it certainly does give us a little bit of an advantage. I think also from a deal size perspective, we're getting access to deals that at really low EVs, and talking back to that sort of margin of safety, if you're buying something at a 2 or 3 mil EV, the chances of that going really wrong for you is just a lot lower. So I think there's an element of that as well. But yeah, look, in terms of more broadly what's in our portfolio right now, like I said, we are looking for those businesses that have got inflecting profitability. We really like recurring revenue. We really like broker business models. We really like things where you can generate high returns on incremental invested capital, or businesses that are able to demonstrate that the investments they've made are generating incrementally higher returns for them.
Do you have a cap on the amount of money that you can manage? I know that like small cap funds can typically outperform those that are bigger, like you mentioned before.
Yeah.
Is there like a ceiling that you would like to hit?
Yeah, I think at the moment, like if we could do 30 to 50 mil in this first class, the zero fee class, that'd be great. And I think at that point we'd reassess whether we want to be taking any incremental money. The small cap fund is a really important part of our business, but at the same time, it doesn't generate, huge amounts of revenue relative to my wealth business and my private client business. So, the product is a little bit underwritten from that perspective. It's not the only thing that we do at Seneca. So I'm pretty happy with that being a smaller niche product that generates really high returns for the investors, including my money that's in there.
I think it's really interesting that you have no management fees on that product, but the 20% performance fee. Why did you choose that model?
Well, for me, that's like great alignment, obviously, with making people money, which I think is why you invest in smalls, is to generate really high returns. I think also, you're not there competing necessarily with a benchmark that is a little bit flawed. And I think from my perspective, if clients are really happy with it, and it's a lot of the money that's in the fund at the moment are my private clients. So, I just wanted to give them a really good deal and what I thought was fair, and, it kind of works out, pretty well for everyone at the moment. So yeah, really pleased.
It's definitely worked out very well for your clients over the last year. Let's take a look forward. Obviously, the RBA hasn't cut rates, which is a little bit disappointing, but we have seen stimulus out of China, which has helped. What's your outlook on small caps over the next 12 months? What do you think investors can expect?
I think the nice thing about smalls is you're not so reliant on market beta, on the market moving, on macro, on the RBA, on China. these things all influence, don't get me wrong, idiosyncratic issues with different companies, but you can have stock-specific things that drive the share price a lot more than, say, what you're going to get out of a Commonwealth Bank or a BHP or a Transurban. So, it is a little bit nice in smalls to be able to look for catalysts. It's a key part of what we do, is trying to identify catalysts for change. And I think in that respect, we don't have to stress so much about macro. That being said, smalls do typically outperform in a rate-cutting environment, and I think if it's not going to be this year, I think at some stage next year we will see that that first rate cut. If the stimulus does come in China, like everyone's sort of thinking it's going to, and maybe the green shoots that have started to emerge do continue to grow, that's going to be really supportive of commodities, which make up a really large percentage of the Small Ords, and for us, is an important part of our investable universe.
Okay, let's get into some ideas then.
Sure.
What do you think are your 3 highest conviction ideas right now, and why are you backing them?
I hate giving high conviction ideas, Ali. I'll do it for you anyway.
I love them though.
I know, because we've got 36 stocks in the portfolio at the moment, and they're all high conviction ideas. That's why they're in the portfolio. We really like PointsBet at the moment. I think that's a business that has clear takeover appeal, but is inflecting in profitability and has been largely overlooked by the majority of the funds management industry in Australia as a cash-burning business, which it's just not anymore after they've returned capital and sold off the US assets. Similarly, like Catapult, the sports GPS tracking business, that's a business which also has been burning a lot of cash historically. It's got a bit of a tarnished reputation among investors, and is also, inflecting towards profitability, growing really steadily, and has got a dominant market position. These have been really good drivers for us over the last 12 months, and I think they've got a long runway to go. There's 2 really good stocks that I think could do well sort of at the top end of our portfolio, some of our heaviest weight positions. And then I think a name like, say, Megaport, even for example, which another stock where the market's sort of fallen out of love with it. The growth hasn't quite been there as much as maybe investors were forecasting, and a stock that you were once buying on 25 times EV to sales, you're now buying on 5 times EV to sales. So you've got that margin of safety there, where if the earnings don't quite come in as you expect, it's not going to matter too much to the share price.
Sounds like you really like those out of love stocks, or those companies that have historically been out of love. How about a stock that everyone's loving right now that you think is getting a little too hot? I feel like there are some small caps that have run incredibly hard over the last 12 months. Is there any small caps that you feel like investors should be aware of or avoiding over the next 12 months? I
don't think it's going to be, you're going to do poorly owning Supply Network. But every fund manager in Australia owns that business. It's on 30 times earnings now. It's got some good sort of tailwinds for growth, and it's got some scope to improve margins. But I think from my perspective, it's not something that from here I would expect to outperform dramatically. It's done really well, don't get me wrong, I'm not criticising it as a good business, but certainly from my perspective, there's better opportunities out there in the smaller end of the market at the moment.
Last question for today, Luke. How can investors access this opportunity?
Yeah, it's open to all wholesale, sophisticated investors at the moment. You can just reach out to me via email, contact us on the website at senecafs.com.au, or reach out via Livewire.
Okay, well, thank you so much for your time today, Luke. I really enjoyed that discussion.
Pleasure, Ali. Thanks for having me.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.